Hello and welcome back. In our last discussion, we explored the intricacies of reporting and analyzing liabilities. Today, we're shifting our focus from what a company owes to what it owns and how it's financed by its owners. This is Chapter 11, all about reporting and analyzing stockholders' equity. This chapter is designed to be a comprehensive review and study tool, aligning with lecture videos and offering guided notes to help you master the material. We'll cover several key learning objectives, from the fundamental characteristics of a corporation to advanced analysis techniques. Here's a quick overview of what we'll explore in this chapter. First, understanding the corporate form of organization. We'll begin by discussing the major characteristics of a corporation. You'll learn that a corporation is a separate legal entity distinct from its owners, created by law, and enjoys many of the rights and duties of a person. Key advantages include limited liability for stockholders, transferable ownership rights, and a greater ability to acquire capital. We'll also touch on some disadvantages, such as government regulations and the concept of double taxation, where corporate income is taxed at both the corporate and individual levels. We'll also look at how corporations are classified, how they are formed, and the fundamental rights of a stockholder, including the right to vote, share in earnings through dividends, and a residual claim on assets upon liquidation. Next, we'll delve into accounting for stock issuance. We'll examine the process of issuing stock, whether it has a par value, no par value, or a stated value. We'll differentiate between the two main components of stockholders' equity: paid-in capital, which are the amounts stockholders invest in the corporation, and retained earnings, the portion of net income retained for future use. We'll also explore preferred stock, which often carries preferential rights over common stock regarding dividends and liquidation, though typically without voting rights. Finally, we'll cover treasury stock, which is a company's own stock that it has reacquired but not retired, and the various reasons why a corporation might purchase it. Our third objective focuses on handling dividends and stock splits. Cash dividends are pro rata distributions of cash to stockholders. We'll break down the three important dates associated with cash dividends: the declaration date, the record date, and the payment date. It's important to note that cash dividends decrease both stockholders' equity and total assets. We'll also discuss stock dividends, which are distributions of a company's own stock to stockholders. A crucial insight here is that stock dividends do not decrease total stockholders' equity or total assets. They simply transfer an amount from retained earnings to paid-in capital, changing the composition of equity. Lastly, we'll cover stock splits, which involve issuing additional shares to stockholders to lower the market price per share and increase marketability. No journal entry is recorded for a stock split, and it has no effect on total paid-in capital, retained earnings, or total stockholders' equity. We'll clarify the differences between stock dividends and stock splits. Our final main objective is to understand how stockholders' equity is reported and analyzed. We'll look at the typical presentation of the stockholders' equity section on the balance sheet, including paid-in capital, retained earnings, accumulated other comprehensive income, and treasury stock. We'll also introduce two vital ratios: the payout ratio, which measures the percentage of net income distributed as cash dividends to common stockholders, and return on common stockholders' equity, or ROE, which indicates how much net income a company earned for each dollar of common stockholders' equity. This section also touches on the strategic decision between debt versus equity financing and its impact on ROE. This chapter is fundamental to understanding how corporations are structured, financed, and how they distribute value to their owners. It builds directly on our previous discussions of liabilities, completing the picture of a company's financial structure. Understanding retained earnings and the statement of stockholders' equity gives us a clearer picture of how a company reinvests in itself and returns value to its owners. These ideas lead us right into our next chapter, the statement of cash flows, where we'll see how all these pieces come together to show the movement of cash through operating, investing, and financing activities. It's where the story of a company's finances really starts to flow, literally. Remember, every step you take in understanding these accounting principles is a step closer to mastering the language of business. Keep up the fantastic work.